Oh my goodness, we got the handsome Paul Krause with us, and Bill Super is just extraordinary CPA. Bill is a leader in the community. Came down to us a number of years ago from Washington State, my old home state, and Bill was very active in the estate planning council up there, and has several years ago revitalized a dying estate planning council to make it one of the top estate planning councils in the whole country. So Bill, honored that you're with us this morning. Hey, Paul, good to see you, bud. I'm gonna click your video off. No offense intended, but we're just gonna, because we're recording. So I'm gonna, there you go. Thanks. You're actually, you're one of the rare guys that are much better looking in person than with your picture. So I might have to have you, take off and put your camera back on, but okay. And Brian Gibbs, Brian is just such, he is the total package. Super smart, great family guy, great insurance guy. He's raised some kids that are super smart in the investment side of things. And just an amazing guy. I've been a huge raving fan of him ever since I sat next to him in a continuing education meeting. So
thank you, RJ. You're too kind. Honestly.
Not kind at all. It's just the truth. I'm gonna click your camera off though, just because we're recording and it'll make it easier so don't have the background distractions. But I'm so delighted you could join us today.
Thank you.
And let's see, where's there we go. And then Linda Harris. Linda has been very, very much the cornerstone of NAFA in San Diego. And sadly, NAFA closed the chapter here, and as did the Society for Financial Services Professionals. But Linda has just taken it on herself to continue to lead the charge. And she is our the face of the very beautiful face, but she's the face of NAFA. And so delighted, Linda, that you're with us. John Hanch, one of my dear, dear buddies, we're in a men's Bible study together, and Hanch Financial Group is one of the penultimate financial groups and has been in Southern California for, golly, how many decades now, John?
So since the 60s is when my father and uncle started it. Yes.
Yeah.
Thank you. Good to see you.
Nice to see you, bud.
RJ.
I'm going to turn off your camera, only, no offense intended, just because we're going to be recording, and it'll make it a little bit easier to not have to worry about distractions in the background. And Brett Gottlieb, you talk about the next generation of leaders. Brett is one of those guys, phenomenal producer, elegant man, and just and one who I just always learn from. I just don't get to see often enough, Brett, but good to see you. I'm glad you're joining with us today.
Thanks for having me.
All right. Max, you are now, you just finished speaking for another event. So I'm just made you a co-host. So you should now be able to show your screen when it comes to it. Sure. We're going to, I want to go ahead and get started here. And just because we've got a very full agenda and we've just got such great talent. I can't wait for you guys to hear both from Tom Camuto, who, as I confessed to him earlier, I've been a stalker of Tom Camuto for years. This guy is such a bright, articulate spokesman for our industry, for what's happening in the big picture, looking ahead on the horizon. We were having a conversation while we're waiting for folks to show up this morning. And the true reality is we're seeing insurance companies just dropping like flies, that they're no longer in the business, or they've gone to no longer writing any more business. And Tom is with Lincoln Financial Group, and thanks to my new friend Tom Tous, who I'll be introducing to him in a minute. But again, Tom, I know Tom Tous is going to be introducing you, but again, we're so honored that you'd be with us. And make time with your busy schedule. And then, of course, Max Bolka, this is our 7th record year in a row financially. And no mistake, no surprise that Max has been my business coach for the last 7 years. So, I see the trail of crumbs connecting there, or whatever the metaphor should be. But Max has got something that's very innovative, and particularly for those of us in the business market, he's going to share an idea that has really been opening some doors for him, and now opening some doors for us as well. So real quick, I want to do a shout out for a couple of meetings that are coming up. We've got the MDRT top of the table meeting in Amelia Island. Hopefully that's still going to happen. If you haven't registered yet, they're limiting the number of live people that can come and live. But, and Linda, I'm going to cloak your screen there, dear. So that's coming up in October 10th to the 13th should be great, though. I'm hoping that that continues to happen in person. I'm looking forward to that. But the EDGE meeting is November 8th through the 10th in Philadelphia. Rob and I were just talking about that earlier. It is going to be another gangbuster meeting. This is much more intimate. It's not 13,000 people like the annual meeting has become. It's 300 to 400 to 500, just North Americans. So it's English speaking only, some great content. And so that's coming up. So, and if you can't make it in person, I believe it's going to be live streamed as well. So it'll be something for you to watch there. Okay, really quickly, I want to let you guys know about that. I'm going to take you to the MDRT website here. And so MDRT.org, for those of you who have not been there or not, it hasn't been a while. And by the way, Ron Farr, I just got to do this, Ron. Sorry, I don't mean to embarrass you, my friend, but Ron Farr, back in '84, I called him up and said, hey, or '85, said, hey, Ron, we're thinking about coming down to San Diego. And he said, are you going to come vacation? Why don't you come stay with us? And I said, no, we're actually thinking about moving there and starting over again. And bless his heart, I think, if I remember right, Ron, I think we stayed with you and Karen. Ron lined up some great people, and that became my Abraham adventure of, after 8.5 years of being in practice in a very up in Spokane, Washington, to pick up roots and start all over again in San Diego, California. And I thought, gosh, the only person I knew in San Diego was Ron Farr. And I thought, if they're as nice as Ron Farr is, and then Terry Kaltenbaugh was the next person I met. And I thought, if they're like Ron Farr and Terry Kaltenbaugh, this is an amazing place to come and practice. And so lo and behold, we did. So anyway, shout out to my buddy Ron Farr. We were also in a study group together, which is, by the way, why I called him out of the blue and asked him if we could talk. Okay, so back to MDRT. I want to bring your attention especially to, number one, here's the upcoming meetings so you can find out more about them. But in particular, I want to drop into this mentoring tab. And there's a couple of things. We have the academy and we have the mentoring program. But what they're doing is they're now going to join forces. And so they're going to be putting together those two programs. And so what's exciting about it is, there you go, you get to see my MDRT membership number right there. But what's exciting about this program—
Hey, RJ, we're not seeing your screen.
Okay, you know what? Thank you, Rob. We go to my Zoom. Sorry, Ring Central. Nope, we're doing Zoom. So let's try this. Hey, Addie. There's another terrific leader, not only just in our San Diego community, but in our international MDRT community. Tremendous leader, Addie Murdoch. So hopefully you can see my screen now.
Looks good.
Okay, cool. So under the mentoring program, this is something that's really exciting. And it's not only just for MDRT members, you can be a non-member. And so just you click into the, again, MDRT.org, go to the part about the mentoring program, and you can enroll right here as a non-member. And then they will match you up with a current member of MDRT. And then on top of that, if you are a current member, maybe you're a regular member, but you want to get to quarter of the table, or you want to get to top of the table, you can either, or maybe you want a mentor. I mean, we've got some great ones. You know, Brian Gibbs, phenomenal mentor. So maybe you choose to mentor. Mike Hood, again. So this is a great place for you to grow personally. It's also a great way for you to give back. So anyway, that's something very, very valuable. Okay, so with that, I'm gonna go stop sharing my screen. I'm gonna introduce my flagship companies. We do a lot of things. 2/3 of my income comes from our assets under management. That continues to grow and is a lovely part of our practice. We also have a tax mitigation element, and we also do quite a bit of consulting. So, and then, oh, surprise, surprise, our life insurance business has suddenly resurged with doing, for the first time in my career, actually, leveraged life insurance. And as you guys probably know, if you're in that space, those cases typically are not small. So it's been fun to all of a sudden go back to my roots of actually doing life insurance and some other big ticket items again. And we've run into situations though where I needed a case manager, and that was, of all the positions on our team, that continued to be the one that we stumbled over. Training, trying to steal somebody, trying to find somebody, and it was really tough. So I had been referred by Relationship Within Pacific Life to contact this fellow by the name of Tous. And Tom is sorry, I'm getting some messages here. I have to close down. Tom is the managing partner for Elite Producer Group, which is a national firm, independent, but has a number of the best companies you would think of. They're all there. And they're very creative, very innovative. In fact, it's thanks to Tom Tous that we have Tom Camuto. But I shared, and so in March, I joined and affiliated with the group, and it's been so helpful to us, not only just from a compensation standpoint, without taking away compensation from relationships I've had in place for a long time, which is why I've not joined other groups, because I didn't want to take away compensation from people that have helped me get to where we are today. And lo and behold, I found out that it's possible to still get more compensation and not take away anything from those within the system that support us. So it was like, why wouldn't I want to do that? Plus, we've been able to get some really extraordinary help in underwriting and other things. So, Tom, would you just give us a real quick flyby on Elite Producer Group? There are several others out there. Unfortunately, one of the biggest ones, FFR, is imploding, but they'll probably come out the other side because they've got some good people. There's M Financial. There's Lion Street is another one.
Partners Financial.
Partners Financial. So there are a number of other good groups out there, and I'm sure that are represented by our folks that are here with us today as well. So EPG is not the only one. For me, when I looked at what I wanted, what I needed, it was very evident there was only a couple to choose from, and I chose EPG, and I could not be more pleased. So Tom, would you just run us by, what is EPG?
Sure.
How does it help customers?
Did you want me to turn my video on?
Sure. Yes, if you will.
Okay.
Please.
Go ahead. All right. Okay, here we are. So first I wanted to say, RJ, thanks for all the kind words. And, we really appreciate the relationship that you and I have, and the challenges that we've been able to overcome. I think I'm almost perfect except one. I couldn't pull a magic underwriting favor coupon out of my hat, but that's going to happen. But thank you to the group for allowing me to attend. So I'll just add a little bit to what RJ said. Is the Elite Producer Group is a wholly owned subsidiary company of Simplicity Life, and some of you may have seen some information about Simplicity over the last maybe year or so, and it all stems back to acquisition. So Simplicity Group Holdings is actually owned by a private equity company that has about $8 billion of cash to deploy. And the goal and objective is to do about 300 million of life target annually and about 10 to 12 billion of annuity in the next 3 to 5 years. And we're going to do that two ways. One is organic growth, and obviously the other is through acquisition. So you'll continue to see maybe news flashes of this organization being acquired or the other, because we've got over 30 in the pipeline, and I think we acquired our 29th firm in the last 4 years. So you can see that they're pretty aggressive from that perspective. But to just give you a quick overview, EPG is unique in the fact that it's a dues-based organization that pays out the top contracts, specifically designed for the producer or agent that does 200,000 a target premium and above. Now, the unique thing also about Simplicity is for those that don't necessarily do 200,000 with outside carriers, we have a fully functioning brokerage general agent that can provide all the help, need, and support that maybe somebody that doesn't have like a full staff like RJ does. So we've got a really unique, let's call it deliverable. In addition, we've got an annuity division that is unique from the other groups, is that it's all under one roof. where everybody else outsources their annuity relationship to another group. So we've really got some interesting and exciting things happening on, let's call it both sides of the house, which would be the BGA side and the producer group. And we're really looking forward to achieving the goal of 300 million. We are actually a little bit more than halfway there, believe it or not, between the two divisions. So exciting things happening. And once again, RJ, thanks for the invite, and look forward to the meeting.
Perfect. So one of the things that Tom and company does is they put together various meetings for us across the year. And several weeks ago, we had the opportunity of getting to hear Tom Camuto, who, if you haven't heard Tom speak before, if you don't know his pedigree, it is intense. It is very, very good. But he's also just one of those gentlemen. He's just a gentleman in our business. So Tom was sharing this presentation about where are we going with these Biden tax hikes and what impact and where do we go from here? Some of them, of course, will not happen, but some of them will. So how do we be responsive? Try not to get political here, but again, had there been more foresight, probably what's been happening over in Afghanistan right now would not be happening with the intensity that it is, according to my SEAL team buddies and others. But that's why we want to be prepared. So no matter where the new legislation goes, we're ready and we have good, solid answers for our clients. So Tom, with that, the floor is yours. Tom Commito, Lincoln Financial Group, Advanced Planning Group, guru in so many different aspects. Thank you for being with us.
RJ, it's a pleasure to be with you, and thank you for the very kind words, and good morning to everybody on the West Coast. Now, if I can do this, which is always a challenge.
Click that little share screen button. There we go.
Yeah, okay, now I got to go to slideshow, I think, right?
Uh-huh.
And from the beginning. And as RJ mentioned, I like to focus on capital gains in the maybe proposals that we have. It's been an interesting 3/4 of a year going back to the election. We actually thought that maybe there was going to be tax legislation in January and February. And of course, there wasn't. Then I was predicting May or June. And like most of my predictions, they were wrong. Now we're looking at September and October. We're getting a little more details, but not a lot. You may be aware that the House of Representatives is coming back early from their summer sojourn. And they'll be back next week, and maybe we'll get some more. But there's been, certainly a lot of speculation and not a lot of details. But I'm going to try to do the best I can, at least, on the capital gain side. Part of the reason that I am doing that is because of the fact that we actually have more detail than anything else. Interestingly enough, actually this morning, Penn Wharton, which does a lot of budget modeling, came out with their budget modeling of at least what they've seen in the Schumer release, which outlined kind of the general goals for the committees. And I've cut out most of this, but it's interesting to see that, first of all, we start at the bottom, that they're predicting that the tax package may raise 4.2 trillion over 10 years. And that'd be interesting because the spending component is 3.5 trillion. So they're actually looking at it and say this may actually close the budget by 700 billion. Be interesting to see if that happens. With regards to tax rates, you can see that raising the top tax rate from the current 37% to 39.6%, raises a little bit of money, but certainly does not raise as much as capital gains. I didn't include it on this slide, but the number one revenue raising item is actually a tax savings, and that is negotiating Medicare drug prices. that's actually $1 trillion over 10 years. So it's kind of an interesting thing to see some numbers. Again, these are independently prepared, but finally we're getting a little bit of detail and seeing how the puzzle pieces, if you will, fit together. Okay, on the capital gains proposals, again, we have more detail than on anything else because the administration did release on April 28th a fairly comprehensive release. And where we are currently, as I think everybody knows, we're at 15% basically. If you're above 445,000, 501,000 for married filing jointly, you're at 20%. And very importantly, we have step-up basis at death. What the administration talked about, first of all, on the living side, if you will, the max rate side, if you will, going to 39.6%. And of course, we know this really is 43.4% because it would include the 3.8% Obamacare tax when you have $1 million of total income, not just $1 million of capital gains, but total income. So if you had $999,999 of wages, let's say, and $2 of capital gains under this proposal, the $2 would be taxed at 43.4%. There would be no step up in basis. And we'll go into a little more details on this. And this would replicate what Canada has. Canada, since 1971, has had what they call the deemed disposition tax, or DDT. And you may remember the old pesticide DDT, so it may be a good acronym. In 71, Canada repealed its federation estate tax and replaced it with a deemed disposition tax, which is a capital gains tax at death. So when you die, it's deemed to be a disposition, just as if you sold the property and you pay capital gains tax at death. Same thing occurs with regards to a gift. When you make a gift, it's deemed to be the same thing as if you sold the property and you pay capital gains. The administration is talking about having some exemptions, and that would be the first $1 million of capital gains at death would be exempt, $2 million per couple, and they would move over the lifetime 500,000 exemption if you sell your primary residence. The first 500,000 of capital gains is forgiven. They would move that over on the deemed disposition side. Interestingly enough, they also talked about some kind of relief for family businesses and family farms, so long as the farmer business was continued to be operated by family members. There was no details, no specification. It was kind of a throwaway, gratuitous statement, but they are talking about that as well. So that's kind of an overview of what the administration has been talking about and what we're potentially looking at. One final thing, and I think this is very, very important, as we talk about this, and one reason why I do like to do this presentation is they mentioned they would like to make this retroactive to April 28th. And the reason for that is what I call the Bob Dylan problem. And you may remember in December, Bob Dylan sold his entire song portfolio to Universal Music for $400 million. And the reason why he did that is they knew last year the top capital gains rate was the 20%, and they weren't sure what was going to happen in 2021. Same thing with making this retroactive to April 28th. They don't want people all of a sudden making last minute capital gains transactions to try to get under the new 43.4% bracket. So what they're proposing is to make it retroactive to April 28th, meaning it's in effect now, even though we don't have any legislation, we don't have any proposals. And I think careful planners are thinking about that, thinking about, okay, if I do a big capital gains transaction today, okay, it actually may be subject to this new higher tax, something to keep in the back of your mind. Okay, now why this big push on capital gains? And I think there are three really strong elements. The first element is this tax paper that last December came from the London School of Economics. It has been by far the most discussed tax paper, tax concepts that I've seen in many, many years. The two authors did some very unique analysis with regards to tax cuts. They actually looked at all 38 OECD countries and looked at the effect. And their conclusion was that major tax cuts, particularly to top income producers, do nothing. Okay, in that it doesn't raise the economy, doesn't raise GDP. And of course, in the United States, we've been operating for the last 40 years on the theory that if you cut taxes, the economy will grow. This will be a boost to the economy. And in their analysis, they haven't seen it. We certainly have seen that since 2017, when we had the Major Tax Act in 2017, and that has not boosted economy. In fact, the economy was actually doing better before the 2017 Tax Act than it was doing after. Of course, part of that's the pandemic. So this has gotten a lot of detail, a lot of very unique analysis, by the way, and that's really
I'm doing great.
driving-
I got all these tax returns in, so I'm beginning to work on them now. So yeah, I'm really excited about that. So what I was
the second reason is this, and this is from Forbes. It's received a great deal of notice, and we certainly know the strife, the personal hardship that the pandemic created. We've all heard stories of many businesses going out of business. You may see that the federal government is actually raising food stamp relief because we have about 30 million people who need food stamps, and just still a complete disaster. The only people who did really well happened to be the 695 billionaires in the United States. And this is part of the chart that Forbes generated, showing substantial growth in wealth during the pandemic for billionaires, while many other people were suffering. So this is another reason why to raise capital gains. The progressives in the Democratic Party really believe that wealthy investors are not paying their fair share. The president certainly believes this, and that working people are overtaxed. So this idea that wealthy investors should pay more taxes is driving this capital gains thrust with regards to fairness, with regards to tax policy. And then finally, the third one is Donald Trump. And, it seems like we have never-ending headlines about Donald Trump and taxes, whether he's fighting the House Ways and Means Committee or whatever, or some of the statements that he made with regards to what the policy should be with regards to taxes. And that's also driving this push that, again, wealthy individuals are getting away with financial murder, if you will, at the expense of common people. And that's all driving this capital gains idea. Okay, finally, and I think this is also very important, the best job in the world is Assistant Secretary of the Treasury for Tax Policy. And this is a number 2 position, by the way, in the Treasury Department, second only to the Secretary. And we have a new Assistant Secretary by the name of Lily Batchelder. She's a very, very accomplished woman, well-known, has worked in the Obama administration, has worked for the Senate Finance Committee, and has been a professor of taxes at NYU. And she's written about the estate tax for almost 20 years. And her bottom line is she would like to repeal the estate tax. She feels the estate tax has too many loopholes. It's too easy for wealthy individuals to circumvent it. And she would replace it with, on one side, the deemed disposition tax. So she's a big proponent of the deemed disposition tax. She would also incur a tax on recipients of inherited property. That a recipient of inherited property would have to include the fair market value of the property as part of their income. We have not heard anything from the new assistant secretary with regards to her thinking on the tax proposal that's kind of meandering its way throughout the Democratic Party. Well, certainly she will have huge input. But if it's her way of thinking, we'd have the deemed disposition tax and a tax on receiving property, and the estate tax would be repealed. Something to watch for, since she is now the major player with regards to setting, at least as far as the administration is concerned, tax policy. Okay, so let me start with an easy question. And the question is, what is the only asset that will get a tax-free step-up in basis if step-up in basis is repealed? And the answer, of course, is life insurance. And most of the time, we don't think of life insurance as getting a step-up in basis, but when you analyze it, it does. Because at death, the death proceeds are income tax-free. So if I pay $100,000 of premium and the death benefit is $1 million, there's no tax on the $900,000 of gain, and indeed the $1 million is income tax-free. So life insurance, we believe, will continue to get a step up in basis. But what does that mean? Well, let's take a look at an individual who, let's say, wants to invest in a Standard & Poor's index fund. The individual can buy it as a standalone mutual fund or ETF. And if step up in basis is repealed, then at death, the gain would be taxable. On the other hand, they can buy it as a clone fund, okay, in a variable UL policy, or they can use it as an index in an IUL policy. And in both cases, there'd be no tax at death. It'd be because of the fact that life insurance has a step up in basis. So one of the things I think is if they repeal step up in basis, we'll see a dramatic increase with regards to VUL and IUL as a device to get around the step up in basis rule that would apply to a standalone mutual fund. Okay, so let's look at individual planning. What can you do? And there has been a great deal of thought since last November, because we kind of knew that capital gains would be on the firing line. Certainly, the Democrats were making that known. And there's been a lot of cogitation, thinking. And in all that time and all that thought process, there seems to be only one solution in handling lifetime capital gains planning. The idea that if you have a big capital gain, you're going to be socked with a 43.4% federal bracket. And as you folks in California know, there would be a 17% tax in California. And before long, there's nothing left. There's nothing left for capital gains. So in terms of looking at the solution, again, many brilliant people looking at the solution, the only thing that they've come up with is a good solution, but it's one we've used for years, and that is a child remainder trust. And as you know, in a child remainder trust, you donate property or cash to the trust. One of the nice things is the grantor can be the trustee, so control investments within the CRT. And the CRT will pay a series of lifetime annuity payments. Now, it can be for the life of an individual, it can be multiple lives, or it can be for a term of years with a maximum of 20 years. For illustration purposes, I like to use the 20-year term because it just makes the illustration a little bit easier. And you get a couple of good things. First of all, when you contribute property to the CRT, it's not deemed to be a sale. So you don't have to pay capital gains tax. Number two is you get a charitable deduction on your 1040 for the fair market value of the property, subject to a maximum yearly write-off of 30% of your adjusted gross income. But if your property is worth more than 30% of your adjusted gross income, you can carry it over for 5 more tax years. And if the CRT, and this is where we get into the planning for capital gains, and if the CRT were to sell the property, so let's say I have some highly appreciated property, I donate it to the CRT, I'm the trustee, I control it, I sell the capital gains property in the CRT, the tax on capital gains is not paid by the CRT because it's a tax exempt entity. It's a charitable organization, if you will. And how the tax is paid is with each payment that comes out of the CRT, let's say for lifetime or 20 years or whatever, it carries a little bit of capital gains. So the capital gains is not paid in year one. Again, if I have a term of 20 years, the capital gains tax is paid over 20 years. Now, what does this do for benefits? Well, it does 2 things. The first thing it does is we have the benefit of deferral. And if I can pay a tax tomorrow, as opposed to paying a tax today, I'm better off. If I can pay a tax 20 years from today, I'm all that much better. So the first benefit I get is not having to pay the tax all in this year. I can pay it over a 20-year period. I'm getting the benefit of the use of that money until I have to pay the tax down the road. The second is the payments will be smaller than, one lump sum capital gains payment. And therefore, if the individual yearly payments are smaller, I may be below that $1 million threshold. Whereas if I had to take it all in 1 year, I'd be above the $1 million threshold and have to pay 43.4%. But if I'm getting dribs and drabs over 20 years, I may be below the million and not subject to the 43.4%. We also have a lot of flexibilities that we can do, particularly with unit trusts in terms of deferring income, can act almost like a deferred comp arrangement. Technique that's worked very well. It's foolproof, if you will. The IRS is not going to challenge you if you do a CRT because everybody knows what the rules are. In fact, the IRS will even give you a specimen trust to do a CRT. Okay, so let's take a look at an actual case that I have here. And what I did is I'm doing a charitable remainder unit trust, putting $1 million in. I'm assuming a 7% return each year, and I'm assuming 7% growth. Now, the reason why I'm doing that is to keep the numbers level. So you can see I put in $1 million, and then at the end of 20 years, the remainder is also $1 million. In reality, I wouldn't do this. In reality, what I would do is I would reduce the remainder. And as long as the remainder is projected at the end of 20 years to be at least 10% of my beginning contribution, I'm okay. So in reality, I may show a remainder of 100,000 here rather than $1 million. But I wanted to keep the numbers level because it's just much easier to follow. And as you can see, out of my distribution of 70,000 a year, basically I have income on 41,000 of it, and the rest is deemed to be return of principal. Now, if you look on the left-hand side, you see that I get a charitable deduction of 235,000 all in year one. So this is a pretty good deal. I'm deferring income over 20 years. It's a good source of income, getting charitable deduction of 235,000. So it works out extremely well, except for one problem. And the one problem is the remainder. Now, the good news is the remainder goes to charity. So we're doing good works, if you will. The bad news is my family doesn't get the $1 million. So how can we really make this a complete and total great financial vehicle is we can replace the remainder that goes to charity with life insurance that goes to our loved ones. Now, there's nothing that says if we replace the remainder with life insurance, it has to be equal to the million. It could be 2 million, it could be more or less, whatever. But it really makes the whole concept wonderful, right? Because I'm getting the charitable deduction. I continue to get the income flow. I'm going to get a deferral of capital gains. And the charity gets $1 million in my example at the end of 20 years. And I'm going to get $1 million out of the income flow back to my loved ones. So it becomes the perfect planning tool, such an effective and easy and wonderful planning tool. And again, with this new capital gains potential tax, it's going to be even more phenomenal. So let's take a look at replacing the $1 million with life insurance. And here I'm using our VUL1 policy, which, as you know, is a guaranteed death benefit VUL. And I guarantee the death benefit to age 102. And so I took 20 payments of $15,000 and bought $1 million, and again, guaranteed to age 102. So I'm getting $70,000 a year back as the annuity payment. Take $15,000 by life insurance, can gift it to an islet, so it's not included in my estate. And this is for the benefit of my loved ones. That still leaves me $55,000 to spend and have a good time. So if you look at the total financial package, really it is works out incredible in terms of how much it can do for our clients, for our charities, and in terms of planning. And again, it's foolproof because we're not going off into the tulips with some new and crazy idea. And again, I throw this out because you may want to consider that doing this now if they make this retroactive to April 28th. Okay, if they make it retroactive to April 28th. So with that, I think we ought to go back here. Let me stop sharing. If I can do that, stop share. Okay, with that, why don't we go back and have questions? So I think, RJ, you wanted to take some questions or have questions at this point in time.
Absolutely. So one of the questions that came in, and by the way, everybody in the bottom there in the chat box, feel free to put some questions in there. But Brian Gibbs asks, what's happening or what's the proposals and the likelihood of proposals changing the 1031 exchange rules on the sale of appreciated real estate? Is it going to be capped, as one proposal seems to suggest? Is it going to be completely done away with, or do you think that'll continue?
No, well, as you know, they paired it way back. First of all, I mean, way back before 2017, was just like-kind property. So if I had any kind of like-kind property, and that was kind of a broad-based definition, I could do a 1031. And they've now cut it back to real estate. Real estate is a very strong industry for growth. And a lot of particularly commercial transactions, some which got really involved, do involve 1031. I don't think they want to get rid of it completely because they don't want to wreck the commercial insurance, commercial real estate industry, particularly now with so many people are working from home. I was interested to see in today's Wall Street Journal that State Street Bank is closing its offices in Manhattan because they have so many people working from home. So because so many people are working from home and commercial real estate is undergoing a lot of changes, I don't think so. I think they're going to leave it because they want to continue to have the economic growth from real estate and real estate investing. But again, like I said, my predictions are always wrong. I tell people if I could predict the future, I wouldn't be here. I'd be at the racetrack. So,
very good. So how will some of the proposed changes affect buy-sell planning and in business owners?
It is. I have a longer presentation and it will dramatically affect buy-sell. And the reason is, if you look at a buy-sell today, it's a tax-free transaction. So let's say I die and I have shares of stock in a business that has zero basis, like you started in my garage, it's worth 100,000. And I'm in a redemption agreement with my corporation. Well, I get a step up in basis of 100,000. And let's say they buy life insurance. So they buy life insurance, they have 100,000 death benefits, so they don't pay any income tax. And I get a step up in basis. So I sell back my stock and get 100,000. It's tax free. Well, now that 100,000, when I sell my stock, is going to be subject to 43.4%. So I'm going to have a source to generate in my estate an additional 43,400 to pay the capital gains tax. So if I have estate tax and capital gains tax, I'm going to have life insurance to pay the capital gains tax. Now, I'm not particularly sad by that, being in the life insurance industry, but it is going to change and make the estate having to potentially pay capital gains. That's going to be a shock to many people. It's really going to be a shock for planning.
One of the other things, Tom, is that the proposal that there would be a limitation on how long an estate trust could be set up to last. Nevada, we have a 365-year time that a trust can last. South Dakota is unlimited. Alaska is unlimited. Delaware, I think, is also unlimited. So one of my questions has been, how could the federal government say to these states, no, you cannot have an extended period of time for your trust to last? Because now it's a classic fight between federal and state law, and presumably it's the United States where states get a choice in this.
No, what they would do is they wouldn't eliminate the trust. They would just tax it. So it's not saying that, and one of the proposals is 50 years, that at the end of 50 years, you would be deemed to have another transfer in trust. So the trust would still exist. They would just tax it at 50 years. So that's how they get away with it, saying, no, your trust can still last, but we're going to impose a tax. I don't think that's going to happen. Okay, that's been kicking around for a while. I'll tell you the number one reason why I don't think it's going to happen is you have to remember that the president came and was a senator for 29 years from the great state of Delaware. And he was a big recipient of trust money from Delaware, from MBNA and Wilmington Trust and others. I don't think he is going to want that provision, doing away with trusts and dynasty trusts and taxing them. He just has too many connections to the trust industry. It's also been a big proposal of Senator Sanders. I lived in Vermont for 35 years. I know Bernie. He's a fine man. He's honest. He's decent. He tries to do well, but his proposals do not fly. So I'm not expecting they're going.
He's also a socialist, but okay.
Yeah, he is. But again, he's a very, very decent man. Just I don't agree with him politically. The other thing is the chairman of the House Ways and Means Committee, very interesting enough, is a guy by the name of Richie Neal from Massachusetts. In his prior life, he was a Mass Mutual agent. And he's very much of a old school conciliator. Working with Republicans and Democrats, and he has come right out and said he doesn't want to do tax reform. He's not opposed to raising revenue, and but he does not want a big tax reform proposal where you change, the grantor trust rules, you change the taxation of trust, and all these other proposals that are being floated out there that would constitute, quote, either tax reform or tax unreform. And I take him at his word that he does not want a lot of statutory changes with regards to the tax code. So I don't see it happening. It'll be really interesting. Again, I'm not that worried about the change in the step up in basis, simply because they've tried it a number of times before. And again, with seeing properties that have been held for 50, 60, 70 years to try and go back and recover that basis information, and to be able, it would be logistically a nightmare, which is why we've repealed
we've put it in
Right.
place and we've taken it away.
Yep.
Well, Tom, thank you so much for being with us. I think it also bodes very well. Lincoln happens to be a major player in the financed insurance arena as well.
Yes.
And it also bodes well, I think, for the finance life insurance with irrevocable trust and dynastic trust planning, even under the new tax code. So it is perhaps will even drive more business to Lincoln than you're already getting, which is a lot.
Right. No, and I think too, if you raise capital gains taxes, we mentioned that's a life insurance opportunity. A number of other proposals would also enhance the use of life insurance. So.
Mhm. Excellent. So Tom Commito, thank you so much. We really appreciate it. You being with us today. I'm assuming that I have your permission to share the
Of
slide
course.
deck. So for those of you that are watching that
Please
want
feel
to get a copy of Tom's deck, and there's a whole bunch more that you didn't get to see today, just send me an email and we'll make it happen. All right. So now, without further wait, let me just again introduce my friend, my business coach, Max Bolka. Max, thanks so much. I know you were literally speaking for another event here until just a few minutes ago. So thank you for making this work. Tell us a little bit about what you're doing, because in addition to coaching financial professionals like myself, you also have some other opportunities that you're opening, other doors that you're opening. On top of that, I get referrals from you for clients that are prospective clients that have over $1 million or more of investable assets that are looking for financial advisors. And so I'm one of the guys that get to pay you for that right. So it's a very clever idea, but you've unearthed something else. So tell us about this income tax thing that you've come up with. Very, very clever.
You can hear me?
I can. And also
see my
those of you
screen?
hopefully got a handout. I did send out a handout from Max last night. So if you didn't get that, maybe in your spam filter. But again, Max, you'll probably be walking us through that checklist right now anyway.
We'll just sit back and enjoy the ride, and we can catch up with the handouts later. Can you see my screen?
Yes, we can.
Higher taxes coming, no problem. Right? Okay, good. So Tom did a great job on the capital gains. What I want to talk about is income tax reduction plans, specifically for business owners. And for those of you who are not familiar with me, I was looking at the attendee list. Out of the 19 or 20 people I think I've worked with, coached directly, probably a third of you guys and ladies. And we don't know, I have to go through the names, but for those of you who are not familiar with me, I'm a 30+ year veteran in the business, somebody I respect greatly, said max cap it at 30. You don't want to know how many years. It's not an advantage when you get up past a certain age. So I've been in this business. I had a nationwide planning and investment clientele. I sold that business many years ago. For the last 25 years, I've been coaching people like RJ around the country. The 4 services you see on the screen right now are directly for financial advisors. I do advisor mentoring. I have an elite advisor program. I have $1 million marketing programs. That's the guaranteed marketing programs that RJ was talking about, where we actually have $1 million leads and up. And I teach you how to close those as well in 1 week, 1 hour, 1 meeting. RJ's been a recipient of probably, I would say, 25 business owners, and half of those have more than $5 million each. So we have guaranteed marketing programs. And then I do financial advisor exit planning. For those of you who want to sell your practice, that's what I do. Now, for the rest of you, I collaborate with advisors of all kinds, CPAs, estate planning attorneys, financial advisors around the country, helping to provide comprehensive legacy planning, master planning for business owners, and income and capital gains tax reduction plans. That's what we're going to talk about today, is the income tax reduction plans. Again, Tom did a great job on the capital gains. So by the time I'm done, you will have no excuse not to cut your clients' taxes, whether they're income or capital gains. Just real briefly, I'm a big personal development fan as a basis for professional success. I'm in a book. I'm writing another book called Take It to the Max. I'm in a movie, et cetera, et cetera. So that's 2 minutes about me. Let's talk about you and your business owners. Most business owners go through this cycle. They build the cash and the cash flow in the beginning. And then, of course, we know there's only 2 things certain in life, right? Death and taxes. But there are myths about that. Every business owner I know out there 90% of them, 99% of them say, I'm going to live forever and work until the day I die. They're in complete denial. They don't want to face mortality. They don't know what to do with themselves after they retire. Heaven forbid something should happen health-wise. Over 80% of most business owners' wealth is tied up in their business. So it's a real myth, death and taxes, because they're in complete denial about death. The only two things certain in life are death and taxes, and death doesn't get worse every time Congress meets, right? That quote is attributed to either Will Rogers or Groucho Marx, depending on who your fan is. Okay, and Nuveen came up with this back in the 90s. It's attributed to a lot of people, but Nuveen actually trademarked it. It's not what you earn, it's what you keep that counts. So I think that says it best. Einstein said the hardest thing in the world to understand is the income tax. Well, I guess he was wrong, but what does he know? It's supposed to be I before E except after C, and he got it wrong twice, right? Here's a list of 12 out of the 55 companies that paid no income taxes, federal corporate income taxes in 2020. Some pretty good names on this list: Nike, FedEx, et cetera, et cetera. You can see the list. Now, Tom, I hope you're still on the line, because look at the last one on this list. Lincoln National knows how to not pay any taxes. The big companies know. All that's going on here is whether it's legacy planning or tax planning, it's now filtering down from the big mega corporations to the middle market. That's all it is. So I'm going to show you today what some companies are doing to cut those taxes. In America, there are two tax systems, one for the informed, one for the uninformed. Both of them are legal. So the company I'm working with does tax considerations in all of these areas. They don't do the asset protection. They don't do the wealth accumulation. That's RJ's job. They don't do the business succession. They don't do the estate planning. They work with all of you people and say, look, if we do it this way and just tweak your plan over here, you're going to save a bunch in taxes. That's all they do. So they look at everything from a tax standpoint. The benefits are that we, and when I say we, I mean my associates, can immediately, significantly, and permanently reduce income taxes. And how do they do that? Well, I can't give you the secret sauce here, but I can describe structurally, conceptually how it works. Number one, it's the structure. They might go in and say, okay, and this is not, by the way, RJ keeps saying this is clever tricks and new and whatever. It's really not. All those companies are already not paying income taxes. And the way they do it is not a secret. There are different structures that you set up, business and legal structures that are set up that then give you access to more deductions. If you jump to the third one, the statutes, it's on the books. At least everything we do is on the books. It has to be an IRS rule, code, regulation, statutes, be proven in different cases. Right now, there's a bunch of tax geeks sitting in a back room salivating over Biden's capital gains, but nothing is going to be implemented, at least by our company, till it's on the books, because otherwise you're taking a big risk. Okay, it's all proven. And when you put all that together, that's the strategy. You take the legal and the financial structures, you have an in-depth knowledge of the tax code, and those are the business strategies that we use that end up getting the tax deductions. And of course, you have to have effective and timely implementation. So who is this good for? Basically, any kind of business owner, small, medium-sized business owners. We're not interested in Nike or FedEx. All industry, all professions. Now that means if you have a doctor, an attorney, if you're a financial advisor, you're a corporation, you can take advantage of this. No W-2 wage income. Okay, that doesn't work because you're not in control of how that revenue is booked. Partnerships are okay, because if RJ and I are partners and one of us wants to do it and one of us doesn't, that's okay. We're set up as a corporation, one of the partners can do it. Okay. Who are we? It's a highly credentialed group of licensed tax attorneys, business consultants, and CPAs. So they're on the team, and we're going to work with your CPA, with your wealth advisor, with your attorney, et cetera. The company was founded 16 years ago now. They've done over 6,500 cases now. This is a year-old data. Basically, all 50 states, diversified industries. I'm not going to go through who the founders are and everything. It's part of the secret sauce. Everybody who does this has to sign a non-disclosure agreement. Basically, they've got proprietary knowledge, and we all sign an NDA. But the first managing partner, I can tell you, he was frustrated in 1998 with his own taxes. So he found the second guy who was the tax expertise, the tax nerd, over 40 years experience at the top of his game. He helped the first guy and they said, hey, there's a business here. And that's what they did back in 2005. So results count. The average reduction we can have is 30 to 40%. So if you've got a business owner and they're paying $250,000 in a year in taxes, we can take off whatever that is. $250,000 times 40%, that 80, 90,000, right? It's not bad. It's upwards of $100,000 tax reduction. It's every single year, because once the structures are set up and those deductions are in place, they're recurring year after year. You have to be modified every year. Right now, the tax code might be changing, so we want to update it from time to time, but it's every single year. And my associates work with your team, as I mentioned, is total support through both the plan, design, and the implementation. The CPA is not supposed to know how to do this. The estate planning is not supposed to. That's why tax law attorneys exist. Okay, so we work with them, and this is a great marketing tool because the CPA and the attorney are going to get more. They end up getting more business because they're the ones implementing. We show them exactly what to do and what to say, put them front and center. Let me give you a quick case study. This is one of my clients, JJ. She is a certified financial planner up in the Northeast. And she was grossing, this was last year's figures, 450,000. She's on track for 500,000 this year. She was already deducting 260,000. So her income, taxable income, was 190,000. She paid 67,000 in taxes last year. And that's about a 35% tax bracket. We did a plan for her on the 450, and you notice right here, tax-free fringe benefits, we were able to pull out another 104,000. That reduced her taxable income to 86,000. She paid 35,000 in taxes. Basically, we saved her 48% in taxes, 32,000. We charged her $15,000 to do this, and she's going to save 32,000 every year, right? So it's a 48% savings. But the way we got to that was we were able to pull out 104,000 in tax-free fringe benefits. That's like cash in your pocket. So really, it's 136,000 that she's saving for that 15,000. Okay. 6 steps to the client engagement. Here's how we do it. First thing, if you have business owners that you want to sign up, right? The first thing we do is initial discovery. We will review all their tax situation and have a meeting with you, with the business owner, with their attorney or CPA. Some of them show up to this first meeting, some of them don't. That's okay. The second step is we go do crunch the numbers, tax analysis and diagnostics. The third step is we come back for a second meeting and say, this is exactly what we can save you. Here's conceptually how we're going to do it. We're going to create this, we're going to do this, and all the deductions flow through here. And this is what we can do for your tax bracket. And of course, what's the cost? So at this point, the client knows exactly what we can do for them and how much it's going to cost. And then they get to decide if they sign up. If they want to sign up at that point, they will pay a fee. They will sign a non-disclosure agreement at that point. Okay. And then we have another meeting for a deeper dive discovery to maximize the benefits. Then we come back with a full plan review, including the secret sauce. We tell them exactly what to do. The accountants and attorneys and anybody else you want on the line should definitely be there by this point. And then we go through the implementation and the comprehensive support. So right now we average about 1 meeting every week and a half. It takes about 90 days to put this all in place. 60 to 90 days. And then after that, it probably takes about an hour a month for the bookkeeping. If I tell you, you can write this off 25 different ways, somebody's got to keep that log. Just like if you were to do a write off your car, you got to keep your mileage log. So we just teach you how to set up. We provide all that for you. We show your CPA, et cetera, et cetera. Couple of testimonials. That one doesn't have any numbers in it. Let me give you a couple that have numbers. I reduced my taxes by $86,000 the first year. This guy's he's done more since then. He's gone big time. He's been with them about 8 years now. This is Kevin in Oregon. He said, I saved $70,000 in income tax. I could have saved more if I had done everything that they recommended. And then this one I pulled out because this is Mark. He's a financial advisor. If you are in the business and you can save your client $100,000 in taxes, where does that $100,000 go? Well, hopefully you have places where they can put that money every single year. All right, coming up to the conclusion here. Folks, you know it's the 80-20 rule. 80% of all the money in our industry is made by the top 20% of the advisors. The other 20% of all the money being made, unfortunately, is split among the bottom 80% of the advisors. I work with and want to help you become one of the 20% of advisors. Doesn't matter if you're a financial advisor, you're an attorney, you're a CPA. As long as you have access to business people, we can show them what to do here. So I tell business owners when I do this for the business owners, this presentation, I say it's your choice. But one of the choices is not to not write a check. You are going to write a check. The only question is, who are you going to write it for and how much? You can hire professional tax planning like us and get quantifiable benefits every single year, or you can continue writing a much larger check every year to tax authorities. Those are your two choices. Excuse me. The business owners gets a custom analysis. They get the tax savings assurance plan. All of that is free up front. Personally, I told the company, you're crazy. You should be charging for it. But they do it for free. And then they get to decide if they want to hire us, and then we show them everything and guide them each step along the way. What are the benefits for you, the advisor? If you haven't seen the benefits already, let me spell them out for you. Number one, you get to keep all of your existing revenue. Your financial planning, your retirement planning, your estate planning, your assets, your insurance, the annuities, all the great things Tom and RJ have been talking about. You keep all that. You're just outsourcing the income tax plan like you would outsource anything else. Okay. The second thing, you get referrals. Once that business owner and their professional advisors see what you can do, they all come running and say, I've got 4 more families, 4 more businesses I want to turn you on to. And the third thing is you get a referral fee. If your business owner signs up, you get $1,000. We pay you $1,000. If they refer somebody, you get $500. Like if you refer a CPA and that CPA has 6 business owners that they refer, you get $500 for each one of those. And if those people refer somebody, you get $250. Okay. So I know we didn't open up the line yet, so I'm just going to answer my own question. What, in my opinion, is the number one key to serving bigger clients? And the answer is collaboration. And I got to give a shout out to RJ Kelly here. I met RJ 7 years ago. We started working together. It's true. He's had a record year every year. Won't give you his numbers. I'll let you ask him directly about that, but he's doing fantastic. But what RJ taught me is collaboration. We all know that RJ knows everybody in the world. He literally has about 4,000 names on his LinkedIn contact list. But more important, he knows how to collaborate with them, to bring all of you who are on this line and say, look, you do this, I do this, let's work together. We can get bigger and better clients together. That's all we're doing here. You have access. The subject of taxes comes up all the time. You know, Biden's thing with taxes, it's the talk of the town. Now, gee, I really can't talk to you now, RJ, about all this. I have no money. I just paid more in taxes to the government than most people earn in a whole year. Really? How much did you pay? Oh, maybe I could help you with that. If I could help you cut those income taxes, would you like to explore a little bit about how that might work? I mean, you can't have an easier approach than that. And then all the questions come up from there. But I learned that from RJ and how to collaborate, and my business has taken off as well as his. So the next step for you as the advisors, if you're interested, let me know. We'll have a 10-minute, 15-minute introductory call. I can show you how to start approaching these people. I just gave you a short script. You can follow it up with an email. I can give you that email if you'd like. You can doctor it up, make it your own. I don't care. But the goal is you bring them to this type of a webinar. You give me 45 minutes. I'll run them through this. I'll take out the parts about advisors, right? We've got a different one for the business owner. And then it can be you, me, your client, your prospect, any of their other advisors. That's the goal. So in conclusion, the money is either yours or, and at this point, you all shout out theirs. And my point is, how do you spell theirs? THEIRS. Let's take some questions.
Great, Max. Thanks so much for that. And thank you for those embarrassingly kind words. And
It's all true.
We actually have now, I just checked, we're at 8,400 on our LinkedIn profile so far.
84.
So yeah, so it continues to grow. Having a marketing manager does also help with that. But so Max, let's talk about this. Where would you think that in terms of industries or companies that to be approached, where are you finding the most traction on this so far?
So me personally, because I coach financial advisors around the country, I'm doing it with financial advisors like JJ, the CFP in the Northeast, but then they roll it out to everybody. And I wanted to make sure you understood when I said professionals, physicians, anybody who has control over how their income is booked, how their revenue is booked, right? As long as it's not W-2 wage income, but it can be any kind of business owner in any industry. That has nothing to do with it. If they file a corporate tax return, they qualify.
And when you say that no W-2 income, you know, certainly there are some like myself, I take W-2, but I'm also the preponderance of our income comes from our sub S dividends it's coming out.
Yes.
So that's a situation where, yeah, it does make sense to take a look, even though there is some W-2 that's involved.
We're going to fix that.
Yeah.
We're going to get that out of the W-2, put it through the corporation, do our magic, and make it tax-free.
Yeah. So what, folks, go ahead and send your messages into the chat, or if you want to just simply unmute yourself, that's fine as well. And
or I'll just keep talking. I got answers to questions that haven't even been asked yet.
so what else? You and I are working on a couple of other cases where, and this goes to a question I think that Brian asked earlier, what happens if 1031 goes away? And there are some other code section plans. There are some other philanthropic plans where individuals can sell their practice, not pay tax, and or at
Yes.
least defer the tax for up to 30 years.
Yes, you and I are working on one of those right now. My advisor in Dallas does about $500,000 a year. Recurring revenue, we're selling it for 1.2 million. He's going to get half of that up front. I did a good job. He gets 600,000 up front. The only problem is that's going to be taxable. So RJ and I are working on a way where we can make that. You want to tell him?
Well, basically, we're going to completely eliminate the tax on that 600,000 and defer it. So we're not. I should retrace that. Retract that and modify it. We're not going to eliminate the tax, but we are going to defer the recognition of the tax for 30 years.
Yeah.
Up to 30 years if he wants to go that long.
So effectively, we've eliminated it, but
Mhm.
technically we haven't. We've just deferred it, which gives my guy at least 100,000, probably well over 100,000 of savings. So it's not bad. So go ahead.
What as far as CPAs go, because obviously CPAs are a great door opener. Do you find CPAs being willing to listen to this idea? Are they resistant? Do they feel like you're stepping in on their toes? Talk a little about that.
I find there's all kinds. Now, I've been very lucky because I get my RJ Kellys around the country that I coach to bring their CPAs, so it's pre-sold. So I don't get the resistance. But if you go, everybody else on this call, if you go to your business owner and you say, look, how much are you paying in taxes? I can help you with that. Let's get on a webinar with my associate, Max Bolka. We tell them up front, we say, listen, your CPA doesn't do this. They're not supposed to know this. That's why tax attorneys exist. Would you like to invite your CPA now or later? And if your CPA can't get over themselves, because there's a lot of ego there, right? What I don't want you to do, Mr. and Mrs. Business Owner, is go back to your CPA and say, why didn't you do this for me the last 20 years? That's not going to help. They're not supposed to know this, but you can invite them. And if they really can't get over themselves and at least be open to exploring this, my question to you, Mr. and Mrs. Business Owner, before we go any further is, are you willing to do it anyway or find a new CPA? Because we're going to need a CPA to implement, to do your tax returns. And if they say, no, I'm married to my CPA, and if they say no, and I don't want to do this, well, hey, you could save us all some time right now.
What percentage of people do you find when you're sitting down with that business owner, especially showing them ways that you'll be able to save them money? What percentage of them say yes, round numbers? And then for those that say no, what are the reasons why they would not choose to go ahead?
We're having very good success. Probably about 70% say yes, I want to at least attend the webinar and see what's going on. And once they do that, then they see it's legitimate and everything. Sure. But the ones who say no, it's the same that we all have. They're so big, they don't think they're ever going to die. They think that they've done everything they can to cut taxes, or they say, yeah, I know I should, but I don't have time and whatever. And then they have a health issue or something comes up, and then they text me and say, I want to talk yesterday. And it's the same with, same with everything.
Remember a number of years ago now, there was a client, gentleman who was selling his company for $10 million, and he was going to pay about $2 million in taxes. And I said, so if I was able to show you a way to eliminate that $2 million in tax, and now we're talking about $10 million of investable assets, would you be interested? And he said, no. And I thought I misheard him.
Right.
He said, so you would not be interested in learning how we could eliminate the $2 million in tax? And he said, yeah, I'm not interested. And I said, I'm sure you've got a great reason for saying that. Do you mind my asking what it might be? Because it really threw me. And he said, well, two reasons. Number one is that I'm getting far more money than I ever dreamed I would get from the sale of my business.
Right.
And then secondly, this was really instructive. He said, my CPA and tax attorney are friends of mine going back since we were in college together. And if it was really legitimate, they would have told me.
Yeah, even though it's not their job.
Yeah. Now we
Look,
manage 8 million of
learn.
assets for him. I wish we were managing 10 million of assets for him, but okay.
We all learned that early on in our career. I had a $10 million guy, and I said, I can help you save the estate taxes. He says, I'm not interested. I'd rather sell it all now, pay $3 million in taxes, give it to my kids now, and watch them enjoy it while I'm alive. But he was my biggest client 30 something years ago. Mm-hmm. And so, you know what? I asked them why, RJ, but I really don't care what the answer is because there's nothing I can do about it. I'm just curious. A lot of them say, yeah, I know, but, and then they go off. I'm focused on the 70% who say, yeah, let me talk to it.
Now that's a great batting average. Great closing.
Okay.
I don't see any more questions right now. We're coming up at 8 or 11:20. So we still have a little more time left. So guys, if you want to send in some more questions, that's fine. Just shoot them over on the chat. And there may be some more questions that you'll have about on the tax side as well. But in the meantime, Rob, why don't you go ahead and unmute yourself and walk us through kind of what did we hear today? What were some of the key points and what's coming up for our next study group meeting? Not necessarily content wise, although we've got some great content that we're working on, but for our November event.
All right. Thanks, RJ. This is Rob Gasho. So RJ has been doing this study group for the last dozen years, sometimes monthly into bi-monthly, quarterly. At this point, we are setting this up on a quarterly basis. And so the next meeting, you want to set your calendar for our next meeting. And that is for the 16th of November, Tuesday, the 16th of November. Plan is that we will be doing a, give me one quick sec here. I'm just going to find my way here. Trying to turn my camera on. Oh, there we go. Sorry
There we
about that. I was fumbling with the participant screen here. And the plan is that we don't know what's going to happen over the next 3 months, right? So between COVID, booster shots, this is your quarterly booster shot for good ideas. I know a guy who has a good idea and, you know, it gets shared here. So we will definitely be doing a couple of things at the next meeting. We'll be talking about the MDRT Edge, the best practices from the Edge will be coming up next time. We'll be talking about trending topics. So whatever comes up over the next couple of months, we will get added in here and have a 20 to 30 minute specialist and conversation on that. We will be doing some year-end planning ideas. From today, you know, we had some great opening from RJ, Tim Tous. Happy birthday tomorrow, by the way, Tim, or Tom, thank you for joining us today, and happy birthday tomorrow. From the other Tom, looking at capital gains from the Biden proposal, many different ways to approach how we can help our clients reduce their capital gains, some of which are ideas that we can provide to them. Others are where we know a guy, right? And this is the way that we are able to bring referrals to other trusted advisors that we know, and also continue to provide value for our clients. We are seeing the wealthy get wealthier. I personally have had a half dozen clients over the past year that have managed to sell their business and generate very, very significant cash flow, which brings the very important issue of how do we pay the least amount of taxes and how do we pass that along to our heirs in the most effective way. I grew up in Canada, and so I'm very familiar with the deemed disposition rule. It would be a horror show to think that that's the direction that that we may be going here. But again, as the one thing we know, the only thing that is constant is change. And as the tax law continues to change, as our elected officials continue to change, as laws continue to change, we want to keep the knife sharp. And by doing so, attending these types of sessions. Max, always great to see you and hear you. I have been a friend of Max Bolka. Gosh, it's probably been for 8 or 10 years that I've known Max. And he is definitely one guy who is the real deal. So generating referrals for advisors from people that he meets in his business, and then also coming up with that huge collaboration with other advisors and other ideas, where we're able to help our clients with things that are well beyond our own wheelhouse, but bringing them back, looking for more of the same in the future. So the presentation today, I think, has been unbelievable. Lots of good information. If you do want to have Tom's slide deck, please reply back to RJ and request that deck. And we will plan to invite everybody that's on this call to the next study group meeting that's coming up November 16th. We'll be sending out that invitation to the many different lists that we have. Generally very friendly people. RJ would tell you that there are some very nasty people that sometimes get those and reply back. So if you know nice people who are looking for good ideas, bring them along. As always, there is no cost for attending this meeting. There is no cost to bring along upcoming advisors, existing advisors. And these are all people that either are MDRT members, should be MDRT members, or aspire to be MDRT members. All are welcome.
Absolutely. Well, gang, how often do you get to end early on a meeting? So, but I think that's where we're going to be at. We got a couple of lovely chat messages from the chat box. Thank you, Brian, and some others. Grateful to have had the chance to be able to participate in this today, but also over the 12 plus years of kind of helping to build a study group. So Rob is very graciously going to be continuing to take us forward, and it'll be even better as we go ahead. So with that, God bless. Have a great rest of the summer. I know, school is starting again for a lot of kiddos, which is great. So grateful to have Max as a wonderful coach. Thank you for a wonderful presentation and great creative stuff. Tom Camuto is on to other things, but it was good content, great content from Tom. There's a lot more that you didn't hear. So I got some more stuff that I'll be able to send to you if you want those slide decks. And then Tom Tous, thanks for being a great leader, for helping us out already this year, and some just, you're a great go-to guy. What a tremendous addition to our, who do I ask this question of list? And Tom, you've already worked your way up very quickly to up at that top echelon. So with that, everybody, God bless. Go out there and continue to serve, make a difference in the lives of other people. We have the most blessed profession that I can imagine, because not only I have also the blessing of being a presenter at the Edge meeting this year, but it is one of the things, as I was been thinking back over my career, I was able to bring, I had a death claim where literally the case was still in underwriting and the gentleman passed away. And it so profoundly impacted me and gave me such a passion for doing what we do. Is we are the only profession that when calamity strikes, that we are there not only to bring emotional support and wisdom and caring, but we bring what makes a difference in their lives. We bring a check that enables them to continue to have freedom, to continue to have love expressed through that money that spouse or parent left for a family that they loved, or for a business that they cared about. And so what an extraordinary privilege we have to be able to make a difference in the lives of others. So I'm telling you, after well more than 30 years in practice, I am more grateful for what I get to do professionally than I ever have been. And I love my business. I love what we do, but I've never been more grateful for it and enjoyed it more than now. And I hope you feel the same way.
Amen. And thank you, RJ. You're wonderful. And Max, Tom, all of you, it was wonderful meeting today.
Thanks for
Great.
putting this together.
Thank you.
RJ, Rob, appreciate
Thanks,
your
RJ.
efforts.
All
Talk
right, everybody.
soon.
Bye for now. November 16th, be there, be square.
Take care. All right. Thank you.
Thank you.